Have you ever wondered how credit scores work? Have you ever wondered how lenders decide how much you can borrow? Have you ever wondered how they set your credit card limit? Or have you just been ignoring it all because it sounds really boring? Today I'm going to explain the 7 things you need to know about credit scores. Included in that will be the one thing that has the biggest impact on your score and some ways to improve your score. Let's start at the start. What is a credit score? A credit score is a number, and it rates how well or how badly you've been going when it comes to paying bills and repaying your money. To calculate your score, there are 3 companies out there that are collecting all your data around your spending and repaying of your debt. It's Experian, Equifax and TransUnion. You might have heard of FICO as well, or a FICO score. FICO is a company, the Fair Isaac Corporation, and they developed a way to calculate credit scores. So FICO get your data from one of the 3 data collectors, and they calculate your score based on your history and the transactions. There are some other models out there as well, like Vantage Score, but FICO is probably the most common. So you don't have one fixed credit score. Your score will be slightly different depending on which scoring system is used and where the data is coming from. And that's why if you look up your score online and check it against your credit card statement, you might see 2 different scores. They'll probably be similar though. Also, your score changes over time. As new data comes in, they recalculate your score, so it keeps changing, and depending on which model is used, they use that data over different periods of time, resulting in other variables. You should also know that you have the right to review your data in case there's any mistakes. Those big 3 companies I mentioned that collect your data, they'll give you 1 free credit report each year. I'll put a link in the description so you can check that out. Just note, this is to get your credit report. This isn't your credit score. The credit report has all the transactions on it, but it's worth checking to make sure there's no mistakes, and it'll give you a bit more information about the sort of stuff that they're capturing that affects your score. The credit score itself is actually between 300 and 850. Don't ask me why. I'm sure 0 to 100 would have been much simpler, but that's what it is. So what's a credit score used for? So banks use this information to predict how likely you are to pay back a loan on time, or how reliable you are when it comes to paying back money. If you've been a bad boy and missed repayments on a loan, then your score goes down. And if you always pay on time, then your score goes up. That's the simple version, but there's a lot of complexity and other variables in there as well. I'll explain some of those. So if you have a higher score, then the bank or the lender is more confident that you're going to repay any loan or pay off your credit card debt. So they can offer you more money, better terms and lower interest rates. And if you have a bad score, then they won't lend you as much. You're looking at higher interest rates, and actually they might not even lend you at all because they see you as too high a risk. Now, while it would be great to go through life with no debt, I don't know anyone that's ever done it. So if you're going to be borrowing money, you can see why being aware of your credit score is really important. Actually, I did a video on the fastest way to pay down your debt. So watch that one next if you've already got a bit of debt behind you. To show you the impact of a high score, look at this example. Now here's someone with a high score and someone with a lower score. The person with a higher score is going to be offered a slightly lower interest rate, but over the course of a 30-year mortgage, that small change in interest rate is going to have a big impact on the amount of money you save. So, how is it calculated? There's lots of reasons why I can't give you the exact calculation, but there's a lot of common areas that make up your score, which gives you a guide of what they're sort of looking at. 5 main categories actually that they sort of look at, and they weight them as well. So firstly, you have your payment history that takes up about 35% of your score. The amount you owe accounts for 30%. The length of your credit history is 15%. Any new credit accounts you've created is 10%, and the types of credit you're using, that also takes up 10% of the weighting. The first thing, and the most important thing, is that payment history, 35% of the weighting. If you've paid previous loans and credit payments back on time, then it's good for your score. If you've missed any payments, then it's really bad for your score. The second thing they're looking at there was the amount you owe. It's not just the total amount you owe, as some people can afford more debt than others. They're looking at how much of your available credit you're using. This is often called your debt utilization. So if you've got a $10,000 credit card and you're using $9,900 of it, then you're more of a credit risk than someone with a $10,000 credit card who's only got $1,000 owing. Next up was the length of that credit history. If you've had credit for decades and always paid it back, then that's going a lot in your favor. That's why it's harder for younger people who are just getting started. Lastly, they look at the mix between different types of credit and also new credit applications. So they look at whether you've applied for credit recently. Imagine applying for 3 brand new credit cards in the last month. That's obviously going to be a bit of a red flag for them. Once you know your score, you can now look at what range you're in. So let's look at that. So what are credit score ranges? Now, people might look at their individual score, but based on your score, you generally get grouped into one of these 5 ranges. As I said earlier, the FICO score is from 300 to 850. So at the bottom end, if your score is from 300 to 579, then it's generally classed as poor. If you're in this group, then you're unlikely to be offered any new credit. And if you can't get new credit, you can't prove you can pay it back. So it makes it hard to dig your way out of this one. Avoid this group at all costs. From 580 points to 669 is fair. It's still a pretty low score and described as subprime. You'll be classed as high risk and may have trouble getting credit. If you do get it, then you're going to face higher interest rates than the average. From 670 to 739 is called good. This is an acceptable range and where most people find themselves. The average score in the US is about 714. In this range, you're likely to be approved for new credit, but you won't get the best deal. Then we move up to very good, the 740 to 799 range. This is where you'll start getting offered competitive rates. And last, at the top of the list, is the exceptional group, running from 800 to 850. You're more likely to be approved for credit and given the best available rates and terms at this level. About 21% of borrowers make it to this sort of exceptional level, but really you just want to make sure you're in one of the top 2 groups to make sure you're getting the competitive rates. So, how can you check your score? There's a number of different ways, and if you Google it, then you'll get plenty of websites trying to sign you up and give you your free credit score. Remember what I said earlier, you don't have one fixed score. Your score is going to depend on the data set they use, which method they use to calculate your score, and also when you do it. So if you looked up your score from 3 different sources, you're likely to get 3 different scores. They should be similar, but they're likely to be different. If you have a credit card, then that's the first place to check. Many credit card companies provide free credit scores, so you can check your statement or your online account to see if they've made that available to you. Otherwise, when I want good data, I go to the source. So you can go to the 3 main data providers to get your score. As I said earlier, they'll give you a free credit report every 12 months, so that helps you find mistakes, but that doesn't include your score. You'll need to sign up with them to get your score. Some of them have paid plans as well that allow you to get your score regularly, and they monitor your data for changes and updates, so then you can sort of be alerted. I'll put some links in the description to help you out. The bottom line is that knowledge is power. Know that you've got a score, that people are using it to assess you, and know how to find it and keep an eye on it. Also remember your score is a result of your actions, and it's all based on the past. If you want a better score, then you have to focus on the actions going forward. If I was going to buy a house, then I'd work hard to improve my credit score for a year before I bought the house so that I get offered those better rates. Which leads me to the next thing you need to know. So what actually influences your score? I mentioned above the big 5 categories that impact your score, so I'll get into a little bit more detail now. The first and that most obvious factor is, have you made any late payments for any bills or repayments on your credit report? If you missed a payment or been late, then this is a big red flag and it's going to go against you. If it happens once, then you can recover your score, but if you're regularly late, then your score is going to start on a downward spiral. So this is at the top of the list, but there's other factors to consider. If you did pay late, how late was it? Obviously later is worse. Have any of your accounts been sent to a collection agency? How often have you made late payments? How long ago was the last time you missed a payment? The thing that will have the biggest negative impact on your credit score is whether you've declared bankruptcy or had any charge-offs, debt settlements because you couldn't pay, foreclosures, or a financial judgment against you in court. This is the biggest red flag that all the credit providers will see, and it will cause a big drop in your score. So these are all related to repaying credit and paying on time. In terms of the amount you've borrowed, lenders are also looking at things like how much of your available credit you've used, how much do you owe on each type of debt, how much do you owe in total. They also look at the length of credit history to see that long period of time of repaying debts. You'll hear people suggest that you should get a credit card when you're young and leave it open. Even if you pay it off or don't use it, just leave the account active, as that creates a longer history of having credit, which improves your score. On the flip side, applying for lots of new credit recently, that's going to have a negative impact, so don't do that. Lastly, let's talk about how to improve your score. This video is just intended as a beginner's guide to credit scores, so I'll stick to the big tips for now. As we saw earlier, there are 3 categories that have a much bigger impact on your score than the other 2. The first was your payment history, impacting 35%. So it's really obvious, but make sure you pay all your bills and debts on time. The amount owed is the second biggest category, and the one to look at is your credit utilization. Specifically, what percentage of your available credit have you used? Ideally, you want to get that under 30%. So if you've got a $2,000 credit card, then keeping the amount owing under $600 would be ideal. Here's a little hack for you. They take a point-in-time snapshot of your credit utilization at the end of the period for your account. You then have to make a payment within 15 days. So if you instead pay that 15 days earlier, then the amount you have owing when they take that snapshot is going to be lower. So it's going to improve your score because it's going to show that you owe less. The third biggest category looks at the length of your credit history. So get a credit card early, don't use more than 30% of the available money, and also make your repayments on time. That's going to help. But keep that credit card account open, even if you aren't using it, to increase the length of time you've had credit available. Another way is to look into the authorized user hack. Basically, if you get added to a family member's credit card as an authorized user, you now get that card on your credit report. If that credit card has been open for 10 years, then it shows that you've had credit for 10 years. That increases the length of your credit history and improves your score. Obviously, be careful with this one. Make sure you're being added to a credit card with a good history, and don't go spending money on that credit card. If you do, you could screw up your credit score, and worse, you could affect your family member's credit score. That's it for today. A credit score is basically a number to represent your credit history so banks and other lenders can determine how risky it is to lend to you. By paying bills and debts on time, not utilizing all of your available credit, and having a long credit history, you can increase your score. This will give you access to the most competitive rates and terms, which is going to save you a lot of money in the long run.